Welcome everybody to Chill Deal Trades, where I use my 12 years of experience to help you succeed in the markets. Today, we are going to cover the FOMC meeting and really, will the Fed create a recession? We're going to go into overview the most important points from the meeting, what I interpreted and what I saw and what I read between the lines. Then we're going to look at some macro data. Then we're going to go to the technical charts to see what's happening with the SPY, potentially the Qs, and maybe the small caps. But before we hop into things, highlight real quick, I have a Patreon. Come support it. I have a free membership tier. I am uploading monthly stock watch list for the first 100, for the first 50 people. It's going to be free. Once I hit 50 people, it'll go to $1, but every month I will be uploading a watch list of stocks to keep an eye on. We've been killing it this year. I think our portfolio is up about 10 to 15% in the midst of this crazy market. And so this is not bullshit, guys. I'm putting good stocks in there for you to keep an eye on. If you really want to support the channel, hit the $5 a month, get a better TradingView account, Discord, all those different things. I forgot to mention, if you sign up for free, you also get access to the Discord. So things to highlight there. Let's hop right into it. So the first thing I want to go into is what the Fed said about adjustments. So the first thing, no rate cuts and no insights on when. They said maybe one rate cut in the second half of the year. And this is down from what we were projecting originally. We thought they might do 2 to 3 rate cuts, and now they're potentially saying 1 rate cut. So why did the market go up? We'll get to that in a second, but this is really important. Again, we're going to get into the reasons why, but no rate cuts and no insight is very interesting. Raised forecasts, but in a negative way. Let's go through everything that the Fed is concerned about. So core PCE, they increased to 2.8 from 2.5, so they think things are going to get more expensive. Raised, that's spelled wrong, raised inflation forecast at 2.7 to 2.5. Unemployment up 1 point to 4.4. I think unemployment is currently at 4.1, so that is 0.4 basis points higher. GDP growth, this is a big one, down from 2.1 to 1.7. The Fed now thinks the U.S. is only going to grow at 1.7%, which is a huge deal because the last few years we have grown a lot. And the last thing, Fed's fund rate, long-term 3%, but this is way out. This is multiple years out. 2026, I think it'll go down to 3.4, and then at the end of 2027, that's 3.1. Again, this is so important because I think a lot of people thought we'd get down to the high 3s, low 4s by this year, and it might be pushed out to 2026. So that's huge as we think about funding your business. Borrowing money is really expensive, and there's a couple other things that are happening in the economy that might create quite the disaster. So let's actually start interpreting the data. The market was up even though the Fed said that they're not cutting interest rates, because they did say they're cutting back on quantitative tightening. So the Fed has two things: quantitative easing, quantitative tightening. Quantitative easing is printing money. Quantitative tightening is pulling back on the balance sheet. And so even though they're still pulling back on the balance sheet, the Fed said they're cutting from 25 billion to 5 billion. That is a huge cut. We're going to want to keep an eye on this for the main reason. One main reason first is less cutting means that, I think I hit this in the last slide. But the bigger companies are going to keep doing good. And so the reason why we saw the stock market move higher is because when the government is cutting less of their budget, essentially the way to think about it, then that helps create positive flow in the market, right? Like, think about when COVID happened. When COVID happened, they said, we're going to spend all this money, and it flows money into the system. And now the government says, we're still cutting, but we're cutting it down from 25 billion to 5 billion. That is a huge slowdown. And so that might cause positive pressure on stocks again, at least in the short term. But one thing that we do want to highlight here is higher unemployment, lower GDP, higher inflation does create stagflation. So if we see GDP growth below our inflation numbers technically, and we see, job growth slow a lot or job earnings slow significantly, that does create a stagflation environment, which is something that we're going to want to keep an eye on. I think people have been talking about stagflation for a while. I personally don't believe this is going to happen. I believe the inflation data is way off. I think we've got, with having interest rates so high for so long, I think we've pulled most of the inflation out of the economy because the Fed has slowed down things so much. And that's when we talk about the growth rate going to 1.7. The reason we're going under 2% growth rate, which is a huge deal, that is not good. But the reason that's happening is because they've had the rates so high and hasn't been able to produce jobs. Businesses can't borrow money, which then they go to produce goods, which then they go to hire jobs. It's this cascade effect. And the small companies have not been able to do that. The big companies are still producing so much cash flow and holding on that cash flow, or investing into things like AI, right? Like Google, Amazon, Meta, all those companies are investing billions of dollars into infrastructure of AI. But outside of those guys, everybody else is kind of struggling and have been struggling for a while. And so tariffs higher for longer could create short-term stagflation. And again, that is why they're cutting back on quantitative tightening. The Fed is feeling uncertain about tariffs and hiring slowdown. And so instead of decreasing rates, because I think they're still not sure about if they lower rates too quickly, which I already think they're behind the ball. And we'll get to that in a second. But the reason they're concerned is that if we cut rates, then we're going to reintroduce inflation. So they say, instead, we're going to take a smaller move and we're just going to cut our QT quite a bit to slow that pressure down. The second thing, rates higher keeps borrowing pressure higher in the economy, but cutting less may help asset prices go higher. You know that the Fed, whether they believe it or not, the Fed is way more dependent on asset prices than the administration. We've heard it over and over again from Trump and the administration that we want to improve the economy. We're not looking at the stock market. The flip is for the Fed. They're looking at asset prices. In my opinion, are not totally looking at the economy. They're just looking at, do things look good? And so they are, from that lens, okay, how do we make things still look good? Because really, I think they're just so behind on some other data. That's why I think they're slowing down QT. And I think it's a battle between Trump and the Fed right now. Trump has made multiple comments of I'm not going to fire anybody, but I'm going to make pressure on them to cut rates. And so Trump is doing all these things to put pressure on the Fed. I think the Fed is saying, we're sticking to our plan. You're not going to influence us. We're going to keep on our rate cut pressure because Trump really wants those rates down. But the Fed is saying, nope, these are the numbers we're looking at. This is where we believe the economy's at, and we're going to keep on our plan. So I think there's a bit of a battle happening right now, which is not good for us, but hopefully they work things out. Another really important note from the meeting, the Fed used the word transitory. It's been a long time since they've said transitory, back in the COVID days when they were so wrong about it for a couple years. But transitory is back. And the reason they said transitory is back is because the Fed is really uncertain about tariffs. And they're concerned that tariffs, they said to me, in the short term, are going to increase prices. And so they are being sensitive on their cutting because they feel that it's going to cause an increase in prices. And so tariffs potentially causing increase in price in the short term. The Fed saying we're keeping our rates where they are to help counter pressure the inflation is a way to think about it. Because again, the Fed's goal is to get max employment plus inflation down to 2%, which we are still far away off. A couple notes on how I interpret it. Again, to my point before, I think if we do not cut rates, stagflation probability can increase, mostly because we're seeing revisions to GDP growth. And if we see revisions to GDP, that means this earnings seasons will potentially be really bad for companies. And if we see earnings come out, that is going to deflate asset prices. We're going to see pressure in the private sector with jobs and hiring and more cuts happening there, buying less, producing less. And I think that could create a place where growth is now below inflation, and that is technically stagflation. So we just need rate cuts, to my point, to help increase growth and increase job hiring. And that goes to the next point. I don't think I changed the hire, but no one is hiring. The Fed said it on the call today. I was listening to the whole thing, said no one's hiring, but no one's firing, and no one's quitting. So we're not in a bad place where we're seeing a ton of layoffs, but we're not seeing hiring. And if you just go on Google and type in no hiring, no firing, you'll see things like Reddit posts. Like, people have been talking about this for months on Reddit. Is like, why is everybody there's job posts up, but no one's getting the jobs, right? I think there's been a lot of commentary on that. But even articles saying like companies aren't hiring, but they're not firing, they're holding on to employees. So that itself is not bad. But if we start to see companies, whether it's due to prices and margin shrinking for the business, and those businesses start to figure out how to function having less employees, that could start to squeeze the labor market and start to slowly increase unemployment. And if that happens, the Fed is already behind on cutting. The thing you got to realize about the Fed is they always make decisions after they need to happen. That's just how it is, because they look at lagging indicators with their data. And so by the time companies start firing, the recession will basically already be over. And so we'll get to what I believe about where we're at in the recession, but that's just something to know. So Fed mentioned no hiring, no firing. With Fed jobs being cut, I think this is a really important thing. We know that the federal government is downsizing. I think what we're going to start seeing, do we see that unemployment tick up from all the federal jobs being lost? And are those people able to find jobs places? If they're not able to find jobs places, then we're going to start seeing that unemployment creep up, maybe towards the year of, is it 3.4, is it 3.5, or is it 4.4%? Do we hit 4.6? Do we hit the 5%? Then things become a bit of an issue. The Fed's going to be forced to cut. And whenever the Fed is forced to cut, this is the important part. If you're still in here 12 minutes in, if the Fed is forced to cut, then they are behind and we are already in a recession, and we're probably close to coming out of it. The Fed is always late. A pro. We need AI to create more jobs. I'm saying with oil, with building, data centers, manufacturing. If we have a administration that continues to put pressure on the 10-year, if they continue to push oil prices lower, if they make the right partnerships to bring the right key players in to build, that could create a lot more jobs. And so even though the federal government jobs are leaving, if we can then create new jobs with deregulating, right? Like getting rid of a lot of regulation to make things move faster, which the Trump administration is working on, we could offset a potential slowdown and reaccelerate industries that have been honestly in a bear market for many years. And the last one is, I think local governments will start to grow. With the federal government downsizing, I think we're going to see more state level jobs, just as the federal government's giving the states more control, and in that case might create more jobs. So things to keep an eye on. Now let's look at some macro data. So I think the Fed is way off on inflation. I think there's a site, go look at it. It's called Trueflation. And Trueflation says we've been in this, call it mid to low 2s to high 1s, now below 2% as of more recent. And so I think this number is probably very accurate. Where the Fed uses lagging numbers, I think this is more true on the grounds, mostly because we've been hearing things about I think we're all seeing like gas come down. We're seeing eggs come down. Like those are the first of many things. I know where I live, rent prices have been coming down. And this is from the last 6 months. And so I think it's way more true that we are probably below 2% inflation already. And so that's why I'm saying the Fed is behind the ball, because inflation is already so low that they can start cutting. And if they get put pressure on them to cut now versus having to cut in 6 to 8 months when they're forced to because employment has increased so much, then that's going to have a way higher impact on the stock market. So they need a cut to start reaccelerating hiring and reaccelerating industry growth. And I think this data is probably way more accurate. Rolling recession. I've been listening to a lot of Cathie Wood recently, and Cathie Wood has been mentioning that we're in a rolling recession, and we've been in it for years. And so I want you to go and look at the IWM. This is small mid caps, and look since 2021. the mid caps have not gone anywhere in the market, and they've double topped, right? Like, I do think we probably have inverse head and shoulders, so that's a very bullish chart. But these guys have been going sideways for years. And I do believe with the administration's adjustments, and hopefully that we get some rate cuts, I do think that small mid caps are going to accelerate, and that big tech is going to slow down the market. So finally, just some stock market insights. I have been positioning to look for opportunities in smaller names. Specifically, if you want to look into like smaller data center, manufacturing names, maybe even financing with a lot of deregulation happening in types. These are areas that you want to look, because I think there will be a lot of opportunity. Again, if we look at patterns, this is an inverse head and shoulders, right? Head and shoulders typically is up with two shoulders. You just flip it upside down. Now you have an inverse head and shoulders. I think that's what's showing here. But we've been in a rolling recession for years, and I think hoping that the Fed does not mess this up and they actually force us into a recession, if things start moving at the pace they do, I do believe mid and small caps will break out. So this is something I'm starting to position my portfolio around. Next thing, put and call ratio. So we're getting into more stock market things here. We called about how, we might be doing a short-term top here. We do have a big pullback on put to calls, which means more calls are going out of the market or puts are being squeezed out of the market. And then VIX is coming down towards the 50-day moving average. So what I'm honestly looking for, I still do believe we have one potentially lower low or close to the previous low coming up in the next month or so. Very loose, but probably in the next month or so, and we'll get to the technicals in a moment. But what I'm looking for is for the put call ratio to go higher with one more pullback in the market, or I'm looking for the put call ratio to go lower. If the put to go lower, but then break above that 85 that we were at before while the market hits a new low. And I'm also looking for the VIX to pop off the 50-day. If we see this get stuck around the 50-day, we might see the VIX pop up one more time. Maybe not hit as extreme, but maybe towards the 25 level range on the VIX, and that will probably signal the last low in the market. Macro data. 10-year is so important for the economy, and we have seen the 10-year come down since the beginning of the year. Trump and his administration have been continuing to say that they are doing whatever they can to put pressure to lower the 10-year. Again, lowering the 10-year is so important for borrowing and creating economic, it's basically like an economic stimulus, kind of like way to think it naturally. When these rates come down, people borrow more, they produce more, they hire more, and so they're putting a lot of pressure here. And that goes to oil as well. When you look at historically, recessions are always predated by oil prices going higher. And so the administration has been working really hard to get oil prices low. Like we hear it in the news constantly, like increasing supply in the U.S., finding maybe partners overseas for other kinds of rare earths and things to help with the AI build out. And so there's a ton of pressure being put on oil prices. And if we saw oil prices continue to come down, if you look at this chart, like we're in an important lower range. If we can break below this kind of high 60s, low 70s and kind of get to this call it low 60s to high 50s range, that's going to be really, really positive because we haven't been there in a long time. And I think that will help supply the AI build out, which will create a lot more jobs, as well as that whole industry around oil production. So that's something I want to look at for macro. On a more like negative news, we are seeing home builders sell off. So home builders are very connected, again, correlated to recessions, because the U.S. economy is really built. Home builders is such an important industry for jobs in the U.S. And so really what we need to see is the administrations keep talking about we need to lower rates. We need to open up more federal land for building. We need to build more infrastructure, right? Manufacturing, data centers. And the reason why is because if home builders continue to sell off, this is a very, very negative for the U.S. economy. And we typically see home builders crash before the recession happens. So we're going to keep an eye on this to see if home builders continue to sell off. If they continue to sell off and don't find a base here and maybe start a bear market on the home builders, right now it's just our largest retracement. But if we start to see a bear market form over this next year, that could say, we're 6 to 10 months out up to a recession potentially, which will have insane negative pressure on your asset prices. I did not create that last slide. Let's go to the charts. So first thing I want to look at SPX. We've talked about how we believe we're in the 5-wave phase. We have 1, 2, 3. We believe that was our third, and now we're in the 4th leg down. The one thing about Elliott wave theory is you typically have ABCs on the way down. So I think I erased it from the charts, but let's get this ABC down. So saying this is the A, this is the B, A. Let's just say the B's here, and then the C comes down lower typically. That's one way to do it. Another way this pattern sometimes happens is you have A, and you kind of have a sideways triangle, and then we could see some kind of triangle. I am still on a belief that we are probably headed to 540 at the minimum, mostly because when you look at Elliott wave theory, you typically have things retrace between 28 to 38 just call it percent on the Elliott wave, or 0.38%, or 0.38. And so at the minimum, if we just have another small drawdown, we see the 0.382 at about 5.4 K. If we get some additional down pressure, we can also see this come back to the 0.5 sometimes. And so somewhere in this range, if we turn on some SMAs, I think it was the 100-day. Let's check. I'm on the weekly. That's the 50-day, maybe. Let's see here. Nope. So we're testing the 50-day right now. So important level. But we've been seeing the 100-day accelerate. And again, look, we're close to the 50-day or the 50 on Elliott wave. Maybe this continues to accelerate if we get a little bit of relief in the market. Like I said before, we get A, just call it B. I think the 20-day is around here somewhere. And then we maybe get, a downgrade here. And then what we could honestly see is this 100-day continue to kind of move upwards and then maybe hit the ABC down. So that's something we want to pay attention to, whether we hit a double bottom or we hit that C lower. But I do believe that will be the final C down before we see the last leg up in the market. Elliott wave, there are times where you have an overextended C wave. We're getting really technical here, but important moves. This 3-wave. So we saw the 3-wave and we saw a bit of an extension here. Sometimes when the 3-wave extends, your 4th wave cannot make a higher high. So if we see a lot of buying pressure here around, I'll call it like the 6,000 to 650 range, we could put in a high and then maybe a bear market starts. So those are, I would say, the 2 most likely scenarios and what we need to pay attention to. Let's check out the SPY. We still haven't hit our target, guys. We put a target on here that we thought the market would come back up to this range. The reason we believe that is because I'm on the weekly. Let's change this to the daily real quick. On the daily, we have the 200-day at 568, and then we have the 50-day at 590. So we did see this potentially coming up, maybe even all the way to the 20-day, right? We haven't hit the 20-day since here. Whenever you're looking at a market, the 20-day, I would say, is your momentum indicator. So when you see, that's the 50-day. Let's look at the 20-day. The 20-day is typically your momentum indicator. And so a lot of times what you see is you'll see the stock come back to the 20-day, maybe break above a little bit and then come back below. If it fails a 20-day breakout, that means we probably have a leg lower. And so what I'm looking for in the markets is that we come up potentially to the 20-day, maybe false breakout around these really important resistance zones where a lot of supply is, and we break lower. If we do that and we hit a lower high, then what we need to look at is, we'll call this, we'll hit marks. Here's a low low, here's a lower high or higher low, and we have a higher high. And so what we're going to see next is if the market comes up higher and breaks below this level, which let's put a new line here to pay attention to that level. about 560 where we came back on that day. If we break below 560, then we have a new lower low from the recent uptrend. And so we could have a bear flag establishing here, right? Bear flag is downward pressure. You see an upward move, and you have that last downward pressure, kind of like the ABC wave we were talking about. So those are some things we're going to want to pay attention to. Let's go on, let's call it the 4 hour just to see what's happening at a more nuanced level. Actually, the last thing on the daily, which is a really important note I want to hit, is we have the 200-day at let's call it 575, and then we have the 50-day at 590. If we start to see these converge, we have a golden cross. So when the 50-day and the 200-day cross, that is an extreme bear signal. Especially when we look at the daily chart, and if we see those things cross, that is very, very bearish for the market, and we for sure have one more big pullback coming. So that's what we want to look at. The 50-day and the 200-day, do those cross? Do we hit those resistance points and come back down and flush lower on big volume selling? Then we could see one more pullback in the market. Let's go to the 4 hour. 4 hour, we have the 50-day. Again, like, let's just draw a line here. This whole zone here is just going to be so important. And we'll call it this 584 to 575. So that $10 range is so important. If we go in this range and fell lower, then that's a really bearish sign. But if we break above here, I'll draw it for everybody. If we break above here, come back and test these, even this trend line, and then come higher and make a higher high again, and then maybe hit that line, then we're probably going to start seeing positive momentum higher. So those are some things we want to pay attention to in the markets. The market is getting healthier. It's still not healthy, but it's getting healthier. And so we're going to want to pay attention to our resistance points, focus on the SMAs, and also see what economic data we're seeing. Are we seeing unemployment increase? Are we seeing job hiring continue to fall flat or decline even more? But that's what I got. Long video, almost 30 minutes. Hope you understood the markets a little bit more from this video. Love you guys. Oh, but the L word, first L word. Love you guys. Let's succeed in the markets together. We got it.